Hey, Singapore income seekers. Are you chasing high yields from overseas REITs but worried about hidden risks? On the SGX, international REITs dazzle with headline yields, offering you juicy income and global exposure you just can't get from Orchard Road or Jurong alone. But, and it's a big but, headline yield is not what flows into your bank account. After debt costs, taxes, and currency moves, what's left might look very different. If you want to protect your distribution stream, not just the temptingly high percentage, this video is for you. Today, adapted from my latest in-depth Substack deep dive on the investing Iguana, we're decoding the real story behind high-yielding global REITs for Singapore investors. By the end, you'll know which global REITs on SGX look compelling right now, what numbers, checklists, and hidden tripwires you need to watch, how to factor in taxes and currency moves, and exactly what frameworks I use before putting my own cash to work. Who am I? I'm Iggy, the investing Iguana. I turn complex investing issues into bite-sized, Singapore-flavored insights. Everything here is tailored to CPF, SRS, and SGX realities, with the plain English playbook you never got from Wall Street. Here's the roadmap for today. The allure and pitfalls of global REITs. A close look at 4 real SGX-listed REITs, DHLT, Clint, CERT, and DCR. Key comparative insights for SG investors, those silent haircut factors, tax and FX, my action checklist, my personal verdict, and how these ideas fit into your overall plan. Let's jump in. Singaporeans love local property, but SGX-listed global REITs open doors to regions we'd never reach alone. These REITs span logistics hubs in Japan, buzzing IT parks in India, giant European property portfolios, and even US data centers. The benefit? Sector and currency diversification. If Singapore's property market slows, maybe rentals in Bangalore or Frankfurt pick up the slack, cushioning your payout. But there's a catch. Every market layer, interest rates, local debt practices, tax quirks, shapes what finally lands in your pocket. For example, even if a REIT's rental income grows, its payout per unit can fall if borrowing costs, taxes, or FX go the wrong way. Here's the rule. The best global REITs keep their income flowing, even as cycles shift, currencies wobble, or local regulations change. Only those with resilient, well-protected cash flows will deliver steady distributions, rain or shine. Let's spotlight 4 names. On paper, all yield about 6.8%, 8.4%, a tempting lineup, but peel back the first layer, and you'll see why the second look matters more. Daiwa House Logistics Trust, or DHLT, is a logistics REIT, heavy in Japan, with one Vietnam asset. DHLT's engine is strong. Scale helps keep tenants sticking around, and most debts are locked in at fixed rates. The yield is around 7.9%. In the first half of 2025, revenue rose almost 6%. Net property income up as well. But wait, distribution per unit, DPU, fell by 8.6%. Why? Higher interest costs from new and refinanced loans. It's like watching your bonus shrink as your mortgage rate jumps. Occupancy stands at 93.2%, with long 6.5-year leases and rents still rising by 10%. But leverage is high at 47%. Almost all debt is fixed at low rates. Great for now. The risk? Any new loans get repriced higher, squeezing income further. And pay attention, SGD strength versus the yen or dong means your payout in Singapore dollars may fall, even if the REIT's income grows in Japan or Vietnam. So, are you buying stability or a shrinking pie? For now, DHLT's business model and hedging look sound, but unless DPU starts climbing again, be cautious. Would you top up your CPF if your bonus was in freefall? Probably not. Wait for the right signal. Next, let's head to India, where growth is the main dish. CapitaLand India Trust, or Clint, lets you tap booming Indian IT parks, industrial hubs, and data centers. With an AUM of 3.7 B and a yield of about 6.8%, it's a gateway to India's fast lane. Look at the numbers. Property income up 10%, DPU up 9%. Occupancy stays healthy at 90%, with rents on the rise. Here, growth isn't just a marketing line. It's showing up in your payout. Even higher local interest rates haven't dented distribution growth. How? A good mix of fixed-rate debt and timely refinancing. Watch out though. Currency is king. INR moves can swing your SGD returns up or down. And India's rules can change fast. Regulatory risk is real. Yet, the biggest plus is strong management and sponsors. That helps Clint weather volatility and unlock new value. Can India's pace keep beating Singapore's sleepy yields? Or will rupee risk catch up? Decide how much excitement and currency drama you want in your portfolio. Now, to Europe, where diversification meets debt drama. Stoneweg Europe Staple Trust, or CERT, offers a huge spread of over 100 properties across Europe, with a fat yield of 8.4%. The breadth sounds great, until you check the loan calendar. Recent performance, revenue and property income barely grew, yet DPU dropped 7%. High financing costs are eating up the margins. Occupancy is stable at 92%, with 5-year leases, so tenants are sticking. But leverage is about 41.8%. Crucially, no big debt comes due until end 2026. That sounds safe, but 2027 is the landmine. When refinancing happens at probably higher rates, DPU could drop again. Would you buy now for high yield or wait and watch until the overhang clears? If you already hold CERT, keep your eyes peeled for signs of DPU stabilizing or falling debt rates. Because until then, adding more is a high wire act. Ready to tech up? Let's go digital. Digital Core REIT, or DCR, sits in a different league. A global network of top-tier data centers spanning the US, Canada, Germany, and Japan. Quality is high, with occupancy at 98% and assets that should ride the data growth wave. Yield? Around 7%. First half 2025, revenue up 84%, but DPU is flat. Why? Financing costs and selling off some assets mean even a growing business doesn't always mean growing payouts. Leverage is more moderate at 38%, with plenty of room to add debt for future growth. The risks aren't rents or demand, but CapEx, expensive upgrades, tech obsolescence, and currency swings. DCR is solid, well-sponsored, and has room to grow. But without real DPU growth, don't expect rising payouts. Watch for improving DPU trends before committing bigger dollars. If you want all the full charts, checklists, and written playbook, grab this post on Substack. Link is in the description below. Here's where smart SG investors pull out the magnifying glass. The table in my article compares all 4 REITs, and a few things stand out. Clint is the only one with rising DPU, thanks to real growth in a fast market. DHLT and CERT saw DPU drop, mostly due to debt costs and soft rents. DCR's DPU is flat, no matter how good operational stats look. It's a great reminder. High lease occupancy and long lease terms look great, but if interest costs ramp up, that gain evaporates. You can't just rely on property metrics, you need to watch funding costs and macro conditions too. Another table in the post shows that fixed rate debt buffers matter. Once these old loans mature and get refinanced at higher rates, the REIT's cost base jumps, cutting into payouts. Coverage ratios, how well earnings cover interest, are also key and differ widely. So are you investing for today's rate or tomorrow's risk? What's the final yield you pocket after all deductions? Local taxes like US withholding tax at nearly 30% bite deep into advertised yields, often dropping a 7% headline to 5% or less. Europe's tax take varies. And nearly all overseas REITs here can't be bought with CPF or SRS, so you must use regular cash. Always net out tax and currency effects before committing your money. Don't just chase the glossy top-line yield. Which matters more, headline yield or after-tax returns in your bank account? Now for my action framework. To thrive as a Singapore income investor in global REITs, you must balance today's income with tomorrow's risks. The 3 main watch items are DPU direction. Is income rising or shrinking? Refinancing terms. Will new loans erode payouts? And currency exposure. Will SGD strength trim returns? Watch these catalysts closely. When DPU starts an uptrend, a big loan is refinanced favorably, or currencies swing your way, it's time to act. From years on the market, here's my punch list. Put DPU durability above yield. Consistent payouts drive compounding. Net out withholding tax. The yield you get is after the authorities take their share. Currency risk is real. Persistent SGD strength will slice into your foreign income. Read the debt footnotes, fixed rate mix, debt maturity, and ICR, interest coverage ratio. Tell the real story, not just surface yields. Back quality sponsors. Good management and access to capital can pull REITs through crisis and open pipelines for future growth. Match REIT to your own goals. If you want only income, avoid names with falling or flat DPU. Wait for the turn. Most overseas REITs on SGX are cash only, not CPF or SRS eligible. Slot them into your plan accordingly. Use CPF/SRS on local options and foreign REITs for cash yield. Here's how I'm sizing things up in September 2025. All 4 global REITs have solid assets and tenants. The difference is what's left for you, the unit holder, after debt service and FX. In a world of higher for longer interest rates, scrutinize how the REIT manages debt and currency. Chase durable cash flows, not just shiny yields. If a REIT's DPU is fallen, stay on the sidelines. Only redeploy when DPU stabilizes or starts climbing. Look for catalysts like rental reversions, successful cost control, or strong refinancing. The smart move? Hold what's working and be ruthless with laggards. Are you focused on cash flow that compounds or just looking for the next big fat yield? Let's wrap up with the key lessons, your action plan, and what's next. Here's what you can take away for your Singapore investing journey. High yield is tempting, but after-tax DPU is king. Watch debt terms, debt maturity, and sponsor quality. Balance cash-only overseas positions with CPF/SRS eligible income streams at home. Stay patient. Add only when DPU is heading up, not down. If you found this breakdown useful and want the full tables, checklists, and written playbook, grab the original Substack post, links below, like, share, and subscribe for more on-the-ground SG investing wisdom from the Investing Iguana. Want to go deeper? Unlock premium membership for exclusives.